For years now, one of the most trusted voices in personal finance has had a very simple message. Just buy the total US market and hold it forever. No international stocks, no other ETFs, no bonds, no second guessing, and millions of people have followed that advice. But recently, that same person has quietly changed his mind. And I think it reinforces a point that I have been making on this channel for a while. Not to toot my own horn, but I got to drop it in there. And it's basically that betting only on the US feels simple and feels like you're doing passive investing, but it really actually isn't. So let's talk about why JL Collins just moved his retirement accounts into the total world market and why this matters more than people realize. Before we get into this video, just two quick things. Please like, subscribe, and watch the video in its entirety if you enjoy my content. And as always, I'm not a financial advisor. I don't know your personal situation, just a guy on YouTube talking about investing and finance. If you don't know who JL Collins is, he wrote The Simple Path to Wealth. It's a personal finance book that I actually personally love. It's a great book. And he has become one of the strongest advocates of low cost index investing, simplicity, and owning the total US market through the mutual fund VTSAX or the ETF equivalent VTI. And he was not subtle about that argument. He basically said that owning only the US is fine and that very clearly you don't need international stocks. So when somebody with that much conviction makes a shift like this, it's not just noise. It's worth understanding why and not to blindly follow him, but to understand what's changed. In a recent article post by him on February 8th of 2026, JL explained that he's now moving his IRAs, so his tax advantaged accounts, into the ETF VT, which is the Vanguard's Total World Stock ETF that I personally recommend, and that's personally what I invest in. That means owning US stocks, international developed markets, and emerging markets all at global market weight. This is not a performance trade, it's a risk decision, and that distinction does matter. JL Collins is not saying that US stocks are finished, that international stocks are the future, or that even you should rotate your portfolio. But his argument and my argument is much more subtle. It's that the US market today is more expensive than international markets and more concentrated than it's been historically. Essentially, it's been increasingly driven by a small group of companies, mostly the Mag 7. That doesn't guarantee underperformance, but it does increase single country risk. And that's the part that investors do tend to gloss over, especially after the very long winning streak that US stocks have been on. However, this is where knowing your history with the market matters. Over the last 50 years, market leadership has rotated back and forth between the US and international stocks. Just a few examples: the early 1970s through the late 1980s, international stocks outperformed the US. From 2000 to 2009, they also outperformed the US. And in 2010, and recent past 5 or 6 years, the US has dominated, especially with large cap growth. And none of this is controversial, just factual. The only mistake that investors do make, though, is that assuming the most recent winner will stay the winner forever. That assumption has never held up long term. So, resetting this quickly, this isn't about abandoning US stocks. VT is still majority US. This is about removing the assumption that the US must always dominate, because history certainly does not support that argument. Now, let's talk about why this concept might feel so hard for people to actually accept and to execute on. It's sort of this main argument about simplicity versus comfort, right? Most people say they want simplicity, but what they actually want is familiarity. US only investing feels simple because it's familiar. People like Warren Buffett have recommended it. It's worked out very well recently, and it's constantly reinforced by media and other narratives. But familiar doesn't mean diversified, and familiar doesn't mean low risk. A US only portfolio feels simple, but it's actually very opinionated. I've gone as far on this channel to technically call it active investing. VT, on the other hand, feels boring, and boring often gets mistaken for weak, but VT is actually the most agnostic form of investing in stock market equities. A lot of people in the comments have said, well, America's done the best, US stocks are the best, we have the best economy, we have the best stock market, and so on and so forth. And they're obviously not just talking about geography, they're talking about innovation, capitalism, strong companies, and they're kind of missing the important part though. VT already owns those companies inside of the US. It's not a bet against the US, but many of the best businesses in the world, they earn revenue globally, they operate across borders, and they're not always just US listed. So owning only the US is not really a bet on capitalism, it's a bet on where that capitalism is headquartered. And that's a much narrower bet than people actually realize. So this all matters now because over the past year, international stocks have actually outperformed US stocks. Not a lot of hype, not a lot of headlines around international stocks. And no, again, this does not prove anything. It's not a prediction, but this is exactly how leadership shifts usually start. Valuations with earnings per share start to normalize, expectations begin to reset, and then capital slowly reallocates. And this is not a call to chase performance. It's just a reminder that diversification tends to matter most right after people stop believing in it. And here's another thing that matters, especially for people near retirement. Sequence of returns risk matters the most now near retirement. If US stocks underperform for 10 to 15 years, a 25-year-old obviously can wait that out, but a 55-year-old might not be able to. The risk isn't that the US underperforms forever. The risk is that it underperforms at the wrong time in your investment life. And this is where JL Collins' decision makes a lot more sense. As you get closer to drawing down your portfolio, reducing concentration risk matters much more than squeezing out potential extra performance. And again, VT isn't new. It's just been ignored. Like, global diversification isn't a new idea. It's been academically supported for decades, just with not the following performance. And it just didn't feel great during a period of US dominance that we've been in for the past 15 years. Most people don't abandon ideas because they're wrong, they abandon them because they're uncomfortable. And VT has suddenly become a much better option. And VT didn't suddenly morph into something new, it's just become a lot harder to ignore. So, in closing here, the takeaway is not buy VT, it's not sell US stocks, I'm not predicting any winners, it's this. Simplicity isn't about picking the easiest answer, it's about removing unnecessary assumptions. And assuming that one country will dominate global markets forever and ever and ever into infinity is a pretty big assumption. Owning the world is just simply the most agnostic, simplest way to invest. And that's why I push it here on this channel and why I believe in it so much with my own portfolio.